Let me ask you a question. How much of your hard-earned money are you unknowingly giving away to fees, middlemen, or poorly performing investments? If the answer is I don't know, this book is here to wake you up. John Bogle, the legendary founder of Vanguard and the father of index investing, has distilled decades of wisdom into actionable advice that can help anyone build wealth over time. Unlock the full potential of your favorite audiobook summary with in-depth analysis, key takeaways, and practical real-life examples prepared by ElevateU. Hello, everyone, and welcome. Today, we're diving into one of the most transformative books in the world of investing, The Little Book of Common Sense, Investing by John C. Bogle. Whether you're a beginner trying to make sense of the stock market or an experienced investor wondering how to optimize your returns, this book offers a simple yet profound message. Investing doesn't have to be complicated to be successful. Stay with me as we explore Bogle's principles chapter by chapter. By the end, you'll see why simplicity, patience, and discipline are the keys to becoming a successful investor. Let's get started. Chapter 1. A Parable of the Gotrocks Family. Bogle opens the book with a powerful parable about the Gotrocks family, a metaphor for everyday investors. The Gotrocks are wealthy because they own all the stocks in the market, but when they start paying helpers like brokers, fund managers, and consultants, their wealth diminishes due to fees. Key takeaway: the more you pay in fees, the less you keep for yourself. The solution? Own the market through low-cost index funds and minimize interference. Example: imagine earning 8% returns but losing 2% to fees every year. Over time, that seemingly small difference can cost you hundreds of thousands of dollars. Chapter 2. Rational Expectations. Simple Arithmetic of Investing. Bogle emphasizes that investing success boils down to simple math. Your return equals the market's return minus costs. Active management, with its high fees and frequent trading, typically underperforms because those costs erode returns. Key takeaway: aim to capture the market's average return by investing in broad market index funds. Example: over a 30-year period, the average actively managed mutual fund significantly underperformed the S&P 500. Why? High fees and trading costs. Chapter 3. Cast your lot with business. This chapter highlights the importance of thinking like an owner. When you invest in stocks, you're buying ownership in real businesses with earnings and dividends. Key takeaway: focus on long-term business growth and profits, not short-term market noise. Example: Bogle encourages readers to invest in a broad market index fund, which represents ownership in hundreds of companies contributing to the economy. Chapter 4. How most investors turn a winner's game into a loser's game. Here, Bogle explains the common pitfalls of investing: overtrading, chasing hot stocks, and market timing. These behaviors lead to lower returns compared to a simple buy-and-hold strategy. Key takeaway: resist the urge to beat the market, stick with low-cost index funds, and stay invested. Example: studies show that the average investor earns significantly less than the funds they invest in due to poor timing and emotional decisions. Chapter 5. The Grand Illusion. Bogle tackles the illusion of high returns promised by actively managed funds. He reveals how marketing and short-term performance can mislead investors into choosing expensive, underperforming funds. Key takeaway: don't be swayed by flashy ads or recent performance. Focus on long-term results and low costs. Example: even top-performing funds often fail to sustain their success over decades. The majority of them revert to mediocrity or worse. Chapter 6. Taxes, the Silent Killer of Wealth. This chapter sheds light on how taxes silently erode investment returns. Actively managed funds generate higher tax liabilities through frequent buying and selling, further reducing net gains. Key takeaway: index funds are tax efficient because they have low turnover, resulting in fewer taxable events. Example: a buy-and-hold investor in an index fund often pays significantly less in capital gains taxes than an active trader. Chapter 7. The Relentless Rules of Humble Arithmetic. Bogle stresses the importance of realistic expectations. The market's long-term returns are driven by two factors: business growth, earnings and dividends, and speculation, changes in valuation. Key takeaway: don't expect sky-high returns. Build wealth steadily by focusing on what you can control: costs, diversification, and discipline. Chapter 8. Focus on the big picture. Bogle urges investors to ignore daily market fluctuations and media noise. Instead, focus on the long-term performance of the market and your financial goals. Key takeaway: time in the market beats timing the market. Stay the course through market ups and downs. Example: during the 2008 financial crisis, investors who stayed invested in index funds recovered and grew their wealth over the following decade. Those who sold out missed a rebound. Chapter 9. Bond funds and asset allocation. While stocks offer higher returns, bonds provide stability and diversification. Bogle recommends balancing your portfolio based on your age and risk tolerance. Key takeaway: as you get older, increase your allocation to bonds to preserve wealth and reduce volatility. Example: a 30-year-old might hold 80% in stocks and 20% in bonds, while a 60-year-old might aim for a 50-50 split. Chapter 10. The simple strategy for wealth building. Bogle reiterates his central philosophy. 1. Invest in low-cost index funds. 2. Reinvest dividends. 3. Stay disciplined and patient. Key takeaway: simplicity is the ultimate sophistication in investing. Example: Warren Buffett, one of the greatest investors of all time, has advised most people to invest in S&P 500 index funds. Chapter 11. When the numbers work against you. Bogle warns against speculative investments like individual stocks, cryptocurrency, or trendy funds. These often promise high returns but come with high risk and volatility. Key takeaway: stick with proven strategies and avoid the temptation of too good to be true opportunities. Chapter 12. You get what you don't pay for. One of Bogle's most famous quotes is, "In investing, you get what you don't pay for." High fees eat into returns, so minimizing costs is crucial. Key takeaway: the less you pay in fees, the more you keep for yourself. Example: a 1% annual fee might seem small, but over decades, it can cost you hundreds of thousands of dollars in lost returns. Chapter 13. The gift of simplicity. Bogle concludes with a heartfelt reminder: investing doesn't have to be complex. The simple path, investing in low-cost index funds and staying the course, is often the most effective. Key takeaway: simplicity, patience, and discipline are the cornerstones of successful investing. Thank you for joining me on this journey through the little book of common sense investing. John Bogle's timeless wisdom shows us that building wealth isn't about chasing trends or outsmarting the market. It's about minimizing costs, staying consistent, and thinking long-term. If this summary resonated with you, I encourage you to take a closer look at your investment strategy. Are you overcomplicating things? Could you simplify your approach and save on fees? If you found this summary valuable, please subscribe to our channel for more insightful book breakdowns. Until next time, remember, the best investment you can make is in yourself. Take care and happy investing.